Good morning, everyone. I'm Adam Posen, president of the Peterson Institute for International Economics, and it's our pleasure to host this event with the vice chair of the the Board of Governors of the Federal Reserve System, the Honorable Richard H. Clarida. Dr. Clarida was kind enough to let us host his first actual speech as the vice chair of the committee, and we know that he is talking today about the changes to the Fed's statement on longer run goals and monetary strategy. For those of you who are aficionados, you can go back to his October 25th, 2018 speech at PIIE and see many of the seeds intellectually for what bore fruit in the statement and in Chair Powell's speech last week. Over to Vice Chair Clarida, and I will give him a more fulsome introduction after his speech.
Thank you, Adam. Last week, the Federal Reserve reached an important milestone in its ongoing review of its monetary policy strategy, tools, and communication, with the unanimous approval and release of a new statement on longer-run goals and monetary policy strategy. In my remarks today, I will discuss our new framework and highlight some important policy implications that flow from the revised statement and our new strategy. I believe that this new statement and strategy represent a critical and robust evolution of our framework that will best equip the Federal Reserve to achieve our dual mandate goals on a sustained basis in the world in which we conduct policy today and for the foreseeable future. I will divide my remarks into 4 parts. First, I will discuss the factors that motivated the Fed in November 2018 to announce it would undertake its first ever public review of policy strategy, tools, and communication. Second, I will discuss the review process itself with particular focus on the economic analysis and public input the Fed drew on as it contemplated potential changes to its framework. Third, I will briefly summarize the flexible inflation targeting strategy that has been guiding U.S. monetary policy since 2012 in the context of some important changes in the economic landscape that have become evident since then. Fourth, I will discuss the major findings of the review as codified in our new statement on longer run goals and strategy, and highlight some important policy implications that flow from them. Finally, I will offer some brief concluding remarks before joining in conversation with my good friend Adam Posen, which as always I very much look forward to. Now, the fact that the Fed chose to conduct this review does not indicate that we believe we've been poorly served by the framework in place since 2012. Indeed, I would argue that over the past 8 years, the framework has served us well and supported the Fed's efforts after the financial crisis, first to achieve and then for several years to sustain the operation of the economy at or close to both of our goals of maximum employment and price stability in what became the longest economic expansion in U.S. history, of course, cut short by the pandemic. Nonetheless, both the U.S. economy and equally importantly, our understanding of the economy have clearly evolved along several crucial dimensions since 2012. And we believe that in 2019, it did make sense to step back and assess whether and in what possible ways we might refine and rethink our strategy, tools, and communications to achieve and sustain our goals as consistently and robustly as possible in the economy in which we operate today and for the foreseeable future. Perhaps the most significant change in our understanding of the economy is our reassessment of the neutral real interest rate, R-star, that over the long run is consistent with our employment and price stability mandates. In January 2012, the median FOMC participant projected a long-run R-star of 2.25%, which, in tandem with the inflation goal of 2%, indicated a neutral setting for the funds rate of 4.25%. However, in the 8 years since 2012, members of the committee, as well as outside forecasters, have repeatedly marked down their estimates of longer-run R-star, and thus the neutral nominal policy rate. Indeed, as of the most recent summary of economic projections released in June, the median participant currently projects an R-star equal to just 0.5%, which implies a neutral setting for the funds rate of 2.5%. Moreover, as is well appreciated, the decline in neutral policy rates since the global financial crisis is a global phenomenon that is widely expected by forecasters and markets to persist for years to come. The substantial decline in the neutral policy rate since 2012 has critical implications for the design, implementation, and communication of Federal Reserve monetary policy, because it leaves the committee with less conventional policy space to cut rates to offset adverse shocks to aggregate demand. With a diminished reservoir of conventional policy space, it is much more likely than was appreciated in 2012 that in economic downturns, the effective lower bound will constrain our ability to rely solely on the funds rate instrument to offset adverse shocks. This development in turn makes it more likely that recessions will impart elevated risk of more persistent downward pressure on inflation and upward pressure on unemployment that our monetary policy should, in design and implementation, seek to offset throughout the cycle and not just in the downturns themselves. Two other related developments that have become more evident than they appeared in 2012 are that price inflation seems less responsive to resource slack, and also that estimates of resource slack based upon historically estimated Price-Phillips curves are less reliable and subject to more material vision than was once commonly believed. For example, in the face of declining unemployment rates that did not result in excessive cost push pressure to price inflation, the median committee projection of U-star, the rate of unemployment consistent in the longer run with the inflation objective, has been repeatedly revised lower from 5.5% in January 2012 to 4.1% as of June. Projections of U-star by the Congressional Budget Office and professional forecasters show a similar decline during the same period and for the same reason. In the past several years of the previous expansion, declines in the unemployment rate occurred in tandem with a notable and to me welcome increase in real wages that was accompanied by an increase in labor share of national income, but not a surge in price inflation to a pace inconsistent with our price stability mandate and well-anchored inflation expectations. Indeed, this pattern of mid-cycle declines in unemployment coincident with non-inflationary increases in real wages has been evident in the U.S. data since at least the 1990s. With regard to inflation expectations, there is broad agreement that achieving price stability on a sustainable basis requires that inflation expectations be well anchored at the inflation rate consistent with the price stability goal. This is especially true in a world that prevails today with flat Phillips curves, in which the primary determinant of actual inflation is expected inflation. The pre-GFC academic literature derived the important result that a credible inflation-targeting monetary policy that is not constrained by the ELB can deliver, under rational expectations, inflation expectations that themselves are well anchored at the inflation target. In other words, absent a binding ELB constraint, a policy that targets actual inflation in these models delivers long-run inflation expectations well anchored at the target for free. But this copacetic coincidence no longer holds in a world of low R-star, in which adverse demand shocks are expected to drive the economy in at least some downturns to the ELB. In this case, which is obviously relevant today, economic analysis indicates that flexible inflation targeting monetary policy cannot be relied on to deliver inflation expectations that are anchored at the target, but instead will tend to deliver inflation expectations that in each cycle become anchored at a level below the target. This is the crucial insight in my colleague John Williams' research with Thomas Mertens. Indeed, John's research over the past 20 years on R-star estimation and monetary policy design at the ELB had been enormously influential not only in the profession, but also at the Fed and certainly in my own thinking about how our framework should evolve. Now, this downward bias in inflation expectations under inflation targeting in an ELB world can in turn reduce already scarce policy space. Because nominal interest rates reflect both real rates and expected inflation, it can open up the risk of a downward spiral in both actual and expected inflation that has been observed in some other major economies. Inflation expectations are, of course, not directly observed and must be imperfectly inferred from surveys, financial markets, and econometric models. Each of these sources contains noise as well as signal, and they can and sometimes do give contradictory readings. But at minimum, the failure of actual PCE inflation over the past 8 years to reach the 2% goal on a sustained basis cannot have contributed favorably to keeping inflation expectations anchored at 2%. Indeed, my reading of the evidence is that various measures of inflation expectations I follow reside at the low end of a range I consider consistent with our 2% inflation goal. With this brief overview of important changes in the economic landscape, I would now like to discuss the review process itself. In November 2018, the Fed announced that in 2019, the system would undertake a wide-ranging public review of policy, strategy, tools, and communication. This initiative would be the first ever public review of monetary policy strategy ever undertaken by the Fed. From the outset, it was conceived that the review would build on 3 pillars: a series of live-streamed Fed Listens events hosted by each of the 12 reserve banks and the board, a flagship research conference hosted by the Federal Reserve Bank of Chicago, and a series of 13 rigorous briefings for the committee by system staff at a succession of FOMC meetings between July 2019 and January of this year. Now, the Fed Listen series built on a long-standing practice at the reserve banks and the board of hosting outreach events that included a wide range of community groups. But by focusing on a common format in which representatives of these groups were encouraged to tell their stories about how our policies impact their communities and daily lives, it became a potent vehicle for us to better connect with the public our policies are meant to benefit. Although many people across the system were involved in making Fed Listens the success that it was, I would be more than remiss if I did not single out Ellen Mead for her many contributions and attention to detail and organization that were essential to its success. The second pillar of our review, a research conference hosted by the Federal Reserve Bank of Chicago, brought together some of the world's leading academic experts in monetary economics to present bespoke papers on a range of topics central to the review. These papers and the robust discussion at the conference they stimulated were an important input to the review process. The proceedings of the Chicago conference are available as a special issue of the International Journal of Central Banking. The third important pillar of the review is a collection of 13 memos prepared by system staff and discussed by the committee at a number of FOMC meetings over the past 18 months. These memos were commissioned by a system steering committee that included Jeff Fuhrer, Mark Giannoni, and Dave Altig, with extensive input from Trevor Reeve. Tomas Laubach chaired the steering committee, and I must note that we simply would not be here today discussing the significant evolution of our framework without Tomas and the insight, inspiration, and good judgment that he brought to the project and the review process. A collection of the staff memos prepared for the review, along with a report on the Fed Listened series, is now available on the board's website. As I mentioned earlier, the committee devoted 5 consecutive meetings between July and January of this year to presentations by the staff and committee discussions of memos touching on various aspects of the framework review. And it held a lengthy discussion at the July 2020 FOMC meeting about the new statement on longer run goals and policy strategy. While it is fair to say, of course, that the committee discussions revealed among the participants a healthy range of views about and priorities for refining our framework and strategy, some common themes did emerge, and these provided the foundation for the revised statement on longer run goals that the committee discussed in July, approved unanimously last week, and released on Thursday, August 27th. Broadly, we agreed that the economic landscape has changed in important ways, and that as a result, the existing statement and strategy that flows from it need as well to evolve along several dimensions. For example, under our previous flexible inflation targeting framework, the Federal Reserve declared that the 2% inflation objective is symmetric. This term has been interpreted by many to mean that the committee's reaction function aimed to be symmetric on either side of the 2% inflation goal, and that the committee set policy with the aim that the 2% goal should represent an inflation ceiling in economic expansions following economic downturns in which inflation falls below target. Regarding the ELB, the previous statement was silent on the global decline in neutral policy rates, the likelihood that the ELB will constrain policy space, and the implications of this constraint for our ability to achieve our dual mandate goals. As for inflation expectations, the previous statement did discuss expected inflation, but only in the context of mentioning that the announcement of a 2% goal helps to anchor inflation expectations. While this is certainly true, it does beg the deeper question of how well inflation expectations can be anchored if the 2% goal is seen by the public and turns out ex post to be a ceiling. Regarding the maximum employment leg of the mandate, the previous statement discussed minimization of, quote, deviations of employment from its maximum level, but this does not adequately reflect the way that the FOMC has actually conducted policy in recent years before the pandemic, as the actual unemployment rate was declining and for several years remained below the SEP projections of U star. Now, before discussing how our statement and monetary policy strategy have evolved, let me highlight some important elements that remain unchanged. First and foremost, our policy framework and strategy remain focused exclusively on meeting the dual mandate assigned to us by the Congress. Second, our statement continues to note that the maximum level of employment that we are mandated to achieve is not directly measurable and changes over time for reasons unrelated to monetary policy. Third, we continue to state that an inflation rate of 2% over the longer run is most consistent with our mandate to promote both maximum employment and price stability. Finally, because the effect of monetary policy on the economy operates with a lag, our strategy needs to remain forward-looking. As a result, our policy actions depend on the economic outlook as well as the risk to the outlook, and we continue in the new statement to highlight potential risk to the financial system that could impede the attainment of our dual mandate goals on a sustained basis. With respect to the new framework itself, the statement now notes that the neutral level of the federal funds rate has declined relative to its historic average, and that therefore the policy rate is more likely than in the past to be constrained by the ELB, and moreover that this ELB constraint is likely to impart downside risk to inflation and employment that the committee needs to consider in implementing its monetary policy strategy. In this regard, the statement now highlights the committee is prepared to use its full range of tools to achieve its dual mandate objectives. Regarding the maximum employment mandate, the new statement now acknowledges that maximum employment is a, quote, broad-based and inclusive goal, and continues to state that the FOMC considers a wide range of indicators to assess the level of maximum employment consistent with this broad-based goal. However, under our new framework, policy decisions going forward will be based on the committee's estimates of, quote, shortfalls of employment from its maximum level and not, quote, deviations. This change conveys our judgment that a low unemployment rate by itself, in the absence of evidence that price inflation is running or is likely to run above mandate consistent levels, will not, under our new framework, be a sufficient trigger for policy action. This is a robust evolution in the Fed's policy framework, and to me reflects the reality that econometric models of maximum employment, while essential inputs to monetary policy, can be and have been wrong, and that moreover, a decision to tighten policy based solely on a model without any other evidence of cost push pressure that puts price stability at risk is difficult to justify, given the significant cost to the economy if the model turns out to be wrong, and given the ability of monetary policy to respond if the model were eventually to turn out to be right. With regard to the price stability mandate, while the new statement maintains our definition that the longer run goal for inflation is 2%, it elevates the importance and the challenge of keeping inflation expectations well anchored at 2% in a world of low R star and an ELB constraint that is binding in downturns. To this end, the new statement conveys the committee's judgment that in order to anchor expectations at 2%, it, quote, seeks to achieve inflation that averages 2% over time. And in the same sentence that therefore, quote, following periods when inflation has been running persistently below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. This is the second robust evolution of our framework, and it reflects the inherent asymmetry of conducting monetary policy in a low R-star world with an ELB constraint that binds in economic downturns. As discussed earlier, if policy seeks only to return inflation to 2% following a downturn in which the ELB has constrained policy, and inflation targeting monetary policy will tend to generate inflation that averages less than 2%, which in turn will tend to put persistent downward pressure on inflation and potentially also on available policy space. In order to offset this downward bias, our new framework recognizes that monetary policy during expansions needs to, quote, aim to achieve inflation moderately above 2% for some time. In other words, the aim to achieve symmetric outcomes for inflation, as would be the case under inflation targeting in the absence of an ELB constraint, requires an asymmetric monetary policy reaction function in a low R-star world with a binding ELB constraint in economic downturns. It is for this reason that while our new statement no longer refers to the 2% inflation goal as symmetric, it does now say that the committee seeks to achieve inflation that averages 2% over time. Now, to be clear, inflation that averages 2% over time represents an ex-ante aspiration, not a description of a mechanical reaction function, nor is it a commitment to conduct monetary policy tethered to any particular formula or rule. Indeed, as summarized in the minutes of the September 2019 FOMC meeting, the committee was skeptical about the benefit, credibility, or practicality of adopting a formal numerical price level or average inflation target rule, just as it has been unwilling to implement its inflation targeting strategy via any sort of mechanical rule. So in practice, what then is the policy implication of this stated desire to achieve inflation that averages 2% over time? Again, the implication of our new strategy for monetary policy is stated explicitly in the new statement. And at the risk of repeating myself, let me restate it again verbatim. Quote, following periods when inflation has been running persistently below 2%, appropriate monetary policy will likely aim to inflation moderately above 2% for some time. Full stop. As Chair Powell indicated in his remarks last week, we think of this new strategy as an evolution from flexible inflation targeting to flexible average inflation targeting. My remarks today have been focused on our new framework and flexible average inflation targeting strategy. Of course, our review has also explored ways in which we might add to our toolkit and refine our communications practices. With regard to our toolkit, we believe that forward guidance and large-scale asset purchases have been and continue to be effective sources of support to the economy when the federal funds rate is at the ELB. And of course, both were deployed promptly in our March 2020 policy response to the pandemic. With regard to other monetary policy tools, and as we have made clear previously in the minutes to our October FOMC meeting, we do not see negative policy rates as an attractive policy option in the U.S. context. As for targeting the yield curve, our general view is that with credible forward guidance and asset purchases, the potential benefits from such an approach may be modest. At the same time, the approach brings complications in terms of implementation and communication. Hence, as noted in the minutes from our previous meeting, most of my colleagues judged that yield caps and targets were not warranted in the current environment, but should remain an option that the committee could reassess in the future if circumstances changed markedly. Regarding communications practices, our new consensus statement does bring greater clarity and transparency to the way we will conduct policy going forward. And in that regard, I note that Michelle Smith is leading our efforts to make immediately and readily available on the web a bounty of content that will be invaluable to those who desire more granular understanding of our process and review conclusions. Finally, now that we have ratified our new statement, the committee can assess possible refinements to our SEP with the aim of reaching a decision on any potential changes by the end of this year. In closing, let me say that while I was not a member of the committee in 2012, had I been, I would have voted enthusiastically for the January 2012 statement. It was the right statement, and flexible inflation targeting was the right strategy at that time and for the next 8 years. The existing framework served us well by supporting the Fed's efforts after the GFC, first to achieve and then for several years to sustain the operation of the economy at or close to both of our statutorily assigned goals of maximum employment and price stability. But times change, as has the economic landscape, and our framework and strategy need to change as well. My colleagues and I believe that this new framework represents a critical and robust evolution of our monetary policy strategy that will best equip the Federal Reserve to achieve our dual mandate objectives on a sustained basis in the world in which we conduct policy today and for the foreseeable future. Thank you very much for your time and attention, and I look forward now to my conversation with Adam. Thank you.
Thank you, Vice Chair Clarida. As people are aware, there have been severe audio problems for which I apologize unreservedly to everyone who has been watching, to the Federal Reserve, and to Vice Chair Clarida. Please allow us a moment's pause. We have shifted the audio stream directly to YouTube. That is now available. I have tweeted out, and the PIIE has tweeted out the link on YouTube. Please switch to that link for the live feed of the questions and answers in real time with Federal Reserve Vice Chair Richard Clarida. Again, we apologize for this situation. Also, please note that the full text of Vice Chair Clarida's speech is available already online, of course, at the Federal Reserve website and at the PIIE website. And though it is only a partial makeup, the full recording of Professor Clarida's remarks will be made available immediately following this event. All right, that being the case, we now are getting reports that the YouTube sound feed is working properly, and we encourage everyone to go over there. If you look at PIIE and Clarida, it will be on. Thank you, Vice Chair Clarida, for bearing with us. Okay. Without further ado, let us get into the questions, because there are so many, not because of unclarity or lack of purpose in what you said, but the opposite. This is a historic moment in the development of monetary policy by the Federal Reserve. Again, as I noted earlier, we were proud at PIIE to host your first speech as Vice Chair. And at that time, you already were indicating many of these concerns. And of course, that followed immediately in November 2018 with your leadership and the committee announcing the work on the statement, which was, as you said, an incredibly public process. So let me congratulate you and the chair and all the members for the unanimous vote in favor of the statement. Let me now turn to some questions for you. There is a number of questions from market types and others of more rule-based interpretation asking, what does this moderate overshoot or required overshoot actually entail? How fuzzy is this rule about averaging inflation targeting? I think you were pretty clear that the committee does not intend this to be a strict rule, but could you expand a bit more on what's involved in the moderate overshoots and catch-ups?
Sure. Well, as I mentioned in the speech, Adam, of course, under the existing inflation targeting framework, we and other central banks don't mechanically follow any particular rule, although I should say that rules are an essential input into the policy process for thinking of options and communications. The statement on longer run goals and monetary strategy within the Fed is thought of as basically a constitutional, quasi-constitutional document. It's sort of at the 30,000 foot level of the parameters and objectives. Certainly right now we have an initial condition because of the pandemic with a very elevated rate of unemployment and with inflation certainly below our objective. And of course our focus as policymakers is to put in place what we can to get the economy back as quickly as possible to achieving our dual mandate objectives. Obviously, fiscal policy will also have an important role to play in that. I would expect as the economy recovers and as we approach our dual mandate goals, that there will be further communication from the committee on the points that you raised. But right now, given our initial conditions, the focus really is on the framework. I should point out, as I did in my remarks, Adam, that 2% not being a ceiling, but an average is an important result in the pre-crisis literature that I worked on with Mark Gertler and Jordi Galli, forward-looking Taylor rules. You worked on with Rick, Ben, and Tomas Laubach. And that's a very robust framework. So in essence, what we're trying to do, Adam, with this framework is achieve the outcomes that you would without a binding ELB constraint, but that recognizes that because it's there, you do need to adjust policy. You've heard the term opportunistic disinflation, or my colleague Lael Branders talked about opportunistic reflation, and that may be a part of it, but as the statement emphasizes, we believe that in many circumstances it will be appropriate to aim for a modest overshoot of inflation, just to demonstrate that inflation can operate on both sides of that 2% goal.
Thank you. That is really clear, and obviously we're both, you more distinguished than I, veterans of the debates and discussions that Rick Michigan convened back at the New York Fed in 1994, and here you are vice chair. Ben Bernanke, of course, went on to become chair. Rick served as governor, and as you mentioned, Thomas Laubach has continued to play a key role as director.
Yes, indeed.
But so let me follow up on that, Rich. So in this environment that you've mentioned and talking about the need to account for the asymmetries created by the effective lower bound, one thing that did not seem to get considered was an actual raising of the inflation target. I mean, already by last summer at the Fed Chicago conference, it was clear that was not on the table.
That's right.
Could you say a bit more about why that wasn't considered and whether some future FOMC might consider that?
Well, obviously a future FOMC would certainly have the freedom to think about that. You know, very early on in this process, in the fall of 2018, when we discussed at an FOMC meeting the broad parameters of this review, there was very widespread, if not unanimous, support for the fundamental logic of the 2012 statement, which is that price stability in the real world is best achieved with a positive inflation rate of 2%. And we all felt that that was an important definition of price stability over the longer run. And so we thought it was more efficient to have the review focus on things that would be potentially, that could be refined. I don't think this is the time to sort of, revisit the history of 2% or other numbers, but just to say that the committee felt very comfortable, and of course, the existing statement retains the language from the 2012 statement that a rate of inflation of 2% over the longer run is consistent with price stability. So I think that was the conclusion of this committee. I should also point out, Adam, that we unanimously agreed that we think that good practice going forward for future Feds would be roughly every 5 years to have a review of communication strategy and toolkit. So we think that should be an ongoing part of the Fed's institutional practice, and that would obviously afford an opportunity to do that if a future Fed wanted to.
And again, not to be flattering, but as you and I joked, sometimes flattery is for real. Kudos to you, the chair, to Michelle Smith, to Ellen Mead and others who made this such a public process, which the Fed had not done before. And I think that was great. Continuing on the economic strategy and tools side, though, you mentioned that effectively you're going to be asymmetric, or at least that's how we should interpret the movement to shortfalls on unemployment as opposed to deviations. But you and the chair and others have also mentioned concerns about the measurement of U star. In practical terms, is the staff still going to be putting out estimates of the NAIRU? Are we still going to be phrasing things in terms of the SEP? Or is there just going to be more of a, maybe not Yellen 14-point dashboard, but more of a broad-ranged approach of assessing labor market conditions?
So first of all, to answer one element of your question, the committee will continue going forward to 4 times a year to survey participants' views about longer run magnitudes for potential growth, as well as the rate of unemployment consistent with maximum employment. So that will still be part of our process and communication. But of course, historically, and you mentioned Chair Yellen, but certainly it's continued under Chair Powell, and I'm sure under Chair Bernanke and Greenspan, we look, as you know, the Fed staff is very, very capable, and we look at a large number of measures of the labor market. And I think our goal in making the change that we did here in the statement is not to emphasize any particular one. For example, the unemployment rate doesn't tell you anything about labor force participation, for example, or it doesn't even tell you anything about the pass-through from wages to prices. And so I think we're just acknowledging the reality that in order to achieve price stability and maximum employment, we need to be looking at a lot of data, and we didn't want to single out any one particular indicator, but we will still continue to survey the committee and publish those results 4 times a year in the SEP.
No, and obviously the breadth of survey is important, and I, among others, am on the record talking about labor force participation and underemployment as being critical. Let's go to what's really a big question that has also been implied by some of your colleagues on the FOMC who already spoke since the chair, which is the issue of how much the committee, the Fed, can actually raise the inflation rate. I mean, you are proposing, obviously, a framework and a strategy throughout the whole cycle, but is there any reason to think that the Fed actually can push up inflation at this point or in the near term?
Well, Adam, I think so. I think the record shows that in 2018, core PCE inflation was just a touch above 2%. That coincided with the strongest labor market in 50 years. So that's not ancient history. Really, what this framework is about is trying to put in place the policies that get us to those mandate consistent goals as quickly as possible, and just communicating that we're willing to allow the economy to operate at full strength, even if that means a modest overshoot of the inflation objective. But to your narrow question of can the Fed do it, we did it as recently as 2 years ago. So.
No, of course you did, but you did that also at the end of a very long, what should not have been, but turned out to be the end of a long expansion process, and with a lot of fiscal stimulus. So I understand the Fed may not want to comment on fiscal policy, but looking forward in terms of the statement, in terms of what happens in the future, are there any further thoughts about the role of coordination between monetary policy and fiscal policy? Since, as you mentioned, near the zero lower bound, the effective lower bound, fiscal policy seems to be essential.
Good question. And what I'll say on that is, obviously, in order to do monetary policy, you have to have an understanding and a forecast of the parameters of fiscal policy. So in that context, fiscal policy is really an input to the way that we think about policy, but I don't really have anything to say about coordination. It's just we have to understand fiscal policy to implement monetary policy, and that's the way that we're continuing to proceed.
Well, you do mention in your referral to recent minutes the idea that yield curve control is not being considered, for example, but is not completely off the table. And you make clear, as in contrast, as you're well aware from the writing, as opposed to negative rates, which are very clearly said to be off the table. I'm not asking to speculate forward, but just what is the factors in determining whether something like yield curve control or more explicit ties to fiscal policy should or should not be adopted?
Yeah. So let me talk briefly about yield curve control. I personally believe, and I think a number of members of the committee believe, that there's potentially a place for yield curve control, but that yield curve control really most robustly is a complement to forward guidance and traditional large-scale asset purchase programs, but there certainly could be circumstances where it would be considered, and we were very clear in the minutes of our July meeting, and I tried to be very clear in my speech today that it's certainly something that's in the toolkit. We're not inclined or thinking about deploying it right now, but it's certainly in the toolkit and potentially can can have a place. And of course, other central banks, most recently the Reserve Bank of Australia, have deployed a version of that, as indeed did the Fed way back in the 1940s.
Exactly.
And so it's in the toolkit, but it's not something that which right now is something that we're about to deploy.
Thank you very much. Continuing on the subject of the toolkit.
Yeah.
So you mentioned, of course, that forward guidance is part of the toolkit, at least is thought to be. And obviously this framework, as Ben Bernanke has commented, potentially has an effect. The statement announcement has an effect through forward guidance. I mean, are you and the FOMC watching to see the market reaction, the yield curve reaction to the statement? Or are you expecting that you have to take more actual steps in September beyond simply the announcement?
Yeah. Well, let me say a couple of things. First, Adam, one of the implications of running a very public process is that even if there is a robust evolution and a very important evolution in our framework, which I would argue is the case here, market reaction was rather modest because we had done such an effective job at being transparent about the process. So I don't think market reaction is indicative of very much in this case. In terms of guidance, I'm obviously not going to comment on any particular meeting. What I would say is that the minutes to our July meeting indicated that we did have discussions at that meeting about potential ways that we might refine our rates guidance and thinking about the balance sheet. Now that we have concluded our review, I would anticipate that we would return to those discussions, but I wouldn't really want to prejudge where we are going to end up on that.
Thank you. One other tool which you did not mention is the issuance of threshold type rules that we will calendar-based, or in my opinion, better indicator-based guidance about what you will do that might seem to be consistent with the kind of statement you're talking about. Is that something under discussion? Was that something that you feel is consistent with the statement made for future use?
Yeah. Well, a couple of points on that. Of course, threshold-based guidance is something that was deployed by the Bernanke and Yellen Fed. And so that's certainly something that's in the toolkit since it's already been deployed and potentially has a role. I think the minutes, I know the minutes do reveal that we've had just in our general discussions about policy, some participants have discussed versions of threshold guidance. And so, as I mentioned, now that we have concluded the review, I imagine we'll be returning to a discussion of potentially refining guidance and our balance sheet communication. But I don't want to prejudge again where that's gonna end up.
Thank you. We're approaching the end of our time. And again, thank you, Vice Chair, for honoring us to give your speech here and have this discussion. So 2 more questions, if I could. First, speaking about the guidance and the past experience and going back to things you said in a number of speeches, drawing on your market experience at PIMCO, there are market-based measures of inflation expectations. And a key part of the new statement is the anchoring and potentially raising of inflation expectations or worrying about downsides in inflation expectations. Will you be thinking about featuring in particular any kind of measures of inflation expectations more than you used to? Will that become a bigger part of the Fed's discussions?
I'll just limit my comments to what I focus on, and I've discussed this in previous speeches, including one I gave in New York in February. So inflation expectations are sort of like maximum employment. They're a crucial input to policy, but they're unobserved. And I think one of the things I've learned in my nearly 2 years as a governor, vice chair, is that if there's something that's important to policy that's unobserved, you don't want to put all your eggs in one basket. You want to look at a wide range of noisy signals of, in this case, inflation expectations. So in my own case, I look at, I think, a dozen different measures of inflation expectations. I look at market-based measures. I look at surveys. I look at econometric models. And I tend to do either an informal or more formal model averaging across them. And I think they're pretty useful. There's definitely a common component in those dozen measures that gradually moves up and down. As I said in my remarks, and I've said in virtually every speech, I think including at the Peterson 2 years ago for my first speech, that I look at a wide range of measures of expected inflation. I think they're consistent with our price stability goal, but they're certainly for me, they're at the lower end of a range that I consider consistent with it. And so certainly in my case, I look at a number of different measures. Just as we said earlier, we look at a number of different measures of labor market maximum employment as well.
Thank you. And just to close this out, in your previous life as professor, and we mentioned the very fertile intellectual environment in the 90s around New York in monetary economics, you, along with Mark Gertler and others, wrote about international economics and about foreign central banks. And one thing which wasn't mentioned in the statement, which wasn't mentioned in your speech or in Chair Powell's speech, was the issue of exchange rates and international feedback on the US economy. You did commission a very good paper by our Peterson Institute colleague, Maury Obstfeld, for the Chicago conference. How do you see international factors feeding in this new framework you're talking about?
Well, international factors are crucial, and I've written about this over my career and given several speeches on it since I joined the board. And so they're actually very relevant to the discussion. And in particular, the most relevant factor, which we did allude to, I did allude to in my remarks, is that this decline in riskless neutral rates is really a global phenomenon, and that has very important implications because it means that there's a global downward pressure on riskless rates. That means there's global increase in likelihood of hitting the ELB, and it also means, as I've said before, it also means that policymakers in each country need to be humble and cognizant of the fact that there's a substantial global factor driving their neutral interest rates, and ignoring that fact, which we don't, but ignoring that fact would lead to very adverse consequences. So I think there's a global, as we've said, there are very powerful global forces on rates, and there are also very powerful global disinflationary forces. And part of what this review was meant to address is to equip our framework and strategy so that we have the best chance of achieving our goals in the global economy that we're facing today.
Thank you, Mr. Vice Chair.
Thank you.
So again, this is a historic moment in monetary policy and, in my opinion, a catching up of an adaptation of the past inflation targeting flexibly into the realities that you and Chair Powell last week outlined of lower R-star, less responsive inflation to wage pressure, and the need to recognize the zero lower bound or effective lower bound. Thank you for your clarity in speaking with us today. Thank you for honoring us with your presence. Thanks to everyone's patience with our audio feed, which luckily did not impede our lively discussion.
Thank you.
This meeting is adjourned.